Good morning, everybody. It's why have I said March the 17th on this? I do not know. This quickly changed that before Michael Brown spots it. It's the 31st of March. It's Monday. It is the morning blast with myself and Mr. Michael Brown. As usual, before we get underway, let's get the legals out of the way. Nothing discussed in this space session constitute trading or investment advice or infers any kind of endorsement by PIQ, trades PIQ Global Limited or PIQ Suite, or indeed the hosts, which, as you know by now, is myself and Mr. Michael Brown. Good morning to you, Mr. Michael Brown. I appreciate it's not March the 17th. I'm changing that shortly. Oh, one sec. I forgot to invite him as co-host, as I'm having an absolute shocker this morning. There you go. Invite sent. Let's see if I can also change this.
Morning, everyone.
Good morning. I'm having a bit of a stinker today.
Yeah, you really are, mate. Although I will admit I hadn't actually noticed that you'd got the date wrong there until you did mention it. But yeah, I won't. I'll let our listeners know that you forgot to send the preview until you were reminded.
Yep. Absolute stinker. I don't know what's going on. I've woke up this morning as well, like full of beans. I thought, you know what, it's going to be a great week. The sun is shining, and I'm falling at the first.
Deary me. Well, things can only get better, mate. You know,
well,
as you say, it is a Monday morning. The evening's getting lighter. The sun is out. It's heating up. You know, and I see Mr. Rich Bernard's here. He'll agree with me. It's gilet weather outside.
Do you know what I put it down to? I put it down to the fact that I was about to chase Zach for the overnight news roundup. He then sent it over to me very promptly at 8:15. I then asked if he had a good weekend on the slopes, and he's basically just told me he's having the best time ever. And meanwhile, I've been working on PIQ and in the garden all weekend, so I think that put me off a little bit, and I think it just kind of messed my mind up. But anyway, enough about me and the fact that I'm not spending my weekends out partying anymore. Go for it. What's been going on?
Indeed.
What's happening?
Well, first things first, I'm really bloody chuffed and pleased for Judith Chalmers that he's having a good time. Maybe one of these days he'll do a bit of work, but, you know, I won't hold out for a miracle. In any case, good morning, everyone. Welcome to what is, I suppose, Liberation Week as we move towards the proposed reciprocal tariffs that are due to be announced and come into effect on Wednesday, the 2nd of April. Markets beginning the week and actually ending last week on a relatively soft note in terms of risk appetite, with participants focusing on de-risking and trimming their exposure ahead of what is going to be a very, 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 very noisy week on the trade front. As a result of that, we saw equities slide into the weekend, with the S&P 500 ending Friday down by around 2% and the Nasdaq 100 losing around 2.5%, while futures on both sides of the Atlantic trade about 1% softer this morning. As a result of that, we've seen some haven demand into treasuries, with 2-year yields falling around 8 basis points on Friday to 3.91%, and the 10-year yield falling around 11 basis points towards the back end of last week. And we've seen further gains across the treasury curve this morning, with both the 2 and 10-year yield falling a further 5 basis points during the Asia session. That haven demand also helping to push gold higher, with the yellow metal trading 1% higher to fresh record highs on Friday and clearing the $3,100 an ounce mark this morning, again printing fresh record highs during the Asia session. Amid all of this, the foreign exchange market remains somewhat more subdued than you might expect, given all of the nonsense that is going on elsewhere. We have seen some decent upside in the yen, with dollar yen coming back below the 149 figure in early trade this morning, but elsewhere it is a story of very, very marginal dollar softness as the dollar index tracks back below the 104 figure, and very, very marginal upside in other G10 currencies. I think this is very much a market that is in wait and see mode at the moment. In terms of fundamental catalysts, I mean, we may as well start with all the various bits and bobs of political nonsense that we've had over the last few days. Of course, all of this involves President Trump, as you may expect. On the trade front, we had Bloomberg sources reporting on Friday that the European Union is discussing and planning concessions that they will offer to the United States after reciprocal tariffs are imposed towards the middle of this week. This could include the lowering of certain EU duties and the easing of some regulations. This is effectively the EU working out ways that they can try and squirm out of the reciprocal tariffs after they have been imposed. And you would expect that most nations and trading blocs will be working on on similar plans, particularly given that EU officials, according to these Bloomberg sources, were told at meetings in Washington, D.C. last week that there is no way they will be able to avoid these new tariffs being imposed. So focus is now turning to much more of a risk management approach as to how they can make the tariffs as low as possible and as short-lived as possible. I think this is a very, very important point, and this is something that the excellent Helen Thomas at Blonde Money spoke about as well in her weekly note this morning. Markets are pricing Wednesday as if it's the Fed or as if it's non-farm payrolls. And what I mean by that is a binary risk on, risk off event. We have the announcement on Wednesday, and then we can all forget about it. I would strongly disagree with that framing of things.
Sorry, but hang on. I'm going to tap ourselves on the back because I've been, well, myself definitely, and you've been agreeing with me, been saying this for also weeks and weeks.
Oh, absolutely.
Let's tap ourselves on the back a little bit.
Yes, we should. Let's do that. There we go. I think you know, as you say, we have been saying this for a long time, and I think the better way to look at it is Wednesday is the start rather than the end of this nonsense. Because what we're going to see happen, and again, I'm giving myself a shout out. I wrote about this in my morning note this morning. What we're going to see happen is from Wednesday there is going to be a set of countries that go, okay, here are the reciprocal tariffs. Let's now go to Washington. Let's kiss the ring. Let's try and work. Let's try and work out how we can lessen the impact and get these tariffs to be either weakened or removed. There will be a subset of countries that just go, okay, fine, this is what it is. Let's just carry on as if nothing had happened and try and just sort of ignore the United States. And there will also be another group of countries which go, okay, Trump, you want to play this game? We'll throw some tariffs in of our own. And then you end up in a sort of escalatory, retaliatory, tit-for-tat trade war. And of course, all of this is going to contribute to a massive increase in uncertainty, a huge number of headlines on the trade front as tariffs go in and out all over the place. And of course, that's all not forgetting the fact that Trump is also likely to use these tariffs probably for the next 3.5 years as a negotiating gambit. You know, if you are a country that agrees with him, he'll turn the tariffs down a bit. If all of a sudden you step out of line, he'll turn the tariffs up again. So I think it's far, far too complacent to look at Wednesday and go, great, at some point we're going to get a press conference where all of this is announced and then we can go to the pub and forget about it. I think that is most certainly not the way that I would be looking at things.
I completely agree. As I said before, we've been saying for a while that if anything, it will get probably more chaotic after Liberation Day.
Indeed, yes. You know, we do have a laugh and a joke, but sometimes we do say some sensible things on here, don't we?
Very occasionally.
Yeah, very occasionally. As if to epitomise my point there on the issue of tariffs and how Trump loves to use them, we did hear via NBC on Sunday, Trump had called one of their TV presenters moments before she went on air to say that he is, and I quote here, angry and pissed off at Vladimir Putin, of course, the Russian president. And in the same remarks, Trump was threatening to impose a 25% secondary tariff on buyers of Russian crude, quote, at any moment if Russia obstructs a Ukraine ceasefire. Now, I believe in some remarks overnight, Trump did try and distance himself from these comments, although that in itself was a little bit strange because why would you ring a journalist and say that and then 12 hours later say, no, I didn't say that? So I'm not entirely sure what's going on that front, but nonetheless, it is certainly one to watch. It feeds into this broader idea that trade and tariffs are starting to be weaponized. Sticking with Trump, because I've got two more things to say about the Orange Man before we move on from him finally. He spoke with Canadian Prime Minister, Mark Carney on Friday, lucky him, and said that the two had agreed to meet after Canada's election. Now, I think Trump's being very presumptuous here and assuming that Carney's going to win that election, which is, of course, on the 28th of April. But nonetheless, that meeting, apparently, according to the Orange Man, will end up being great for both the US and Canada. Despite that, Mark Carney said, in his own remarks after that call that Canada will implement retaliatory tariffs if the US imposes further measures on the country. And also, in a nod to, again, something we spoke about previously, Carney said that Canada would prefer if Mexico is also involved in trade talks with the United States. So essentially, it seems like the US-MCA trade deal, which was due to be renegotiated next year, the negotiations on that front seem likely to be brought forward. And that's probably how all of these tariffs, at least on the US's two neighbours, end up magically disappearing. The last thing on Trump was a report via Axios on Friday, again late in the day, actually, while I was sat having a beer with you, Ryan. And this is, according to White House officials cited by Axios, the Trump administration is considering allowing higher taxes on the very highest earners in order to deliver some of the other promises that Trump made on the campaign trail. Now, of course, this relates back to the tax cuts that Trump implemented in 2017, which are due to expire relatively soon. And if they do expire, then the top income tax rate would jump by about 2.5% to 39.6%. And also the threshold at which that is paid would be lowered quite considerably. Effectively, this is a little bit of a populist move from Trump, because the argument is if you let the top rate of income tax be restored to the level it was previously, that could free up revenue to implement some of the other policies Trump's been talking about, like getting rid of taxes that are paid on tips and things like that. While it may be
pardon?
tips,
Tips,
as in gratuities.
Sorry.
Get your mind out of the gutter, Ryan. While that may be a popular move with voters, I would be pretty convinced that some of his donors are going to be quite annoyed if that were indeed to come to fruition. Three other things from me this morning, just in terms of data that we had towards the back end of last week. We did, of course, have the latest core PCE figures out of the United States, which is naturally the Fed's preferred inflation metric. Core PCE rose by 2.8% on an annual basis in February, up from the 2.6% that we saw in January. A lot of people getting very overexcitable about this. To be honest, I don't think there's any point doing so, because when Fed Chair Powell was speaking at the press conference a couple of weeks ago, he stood there and said, we expect core PCE to be 2.8% in February. So we're bang in line with the Fed's expectations. Yes, it's moving in the wrong direction, but it's certainly not a surprise to policymakers. And if you've been paying attention, it shouldn't be a surprise to you either, because that's a point I made on the Morning Blast on Friday. Penultimately, we had consumer sentiment figures from the University of Michigan on Friday as well. The headline index falling to 57, down from the preliminary read of 57.9 and the February print of 64.7. Year-ahead inflation expectations rose to 5%, while 5 to 10-year inflation expectations rose to a 3-decade high of 4.1%. Now, unfortunately, I'm going to have a little bit of a rant here, because
get comfy.
Yeah, go and make yourself a cup of tea, because the UMich survey has attracted far too much attention for what it is, which is essentially nonsense. Now, there are two main issues with the University of Michigan's data. The first is that the survey size is tiny. In a country of about 300 million people and 160 odd million working adults, the University of Michigan ring over the phone 500 people to come up with that consumer sentiment number. For a bit of context around that, the Conference Board, who publish a consumer confidence survey of their own, they survey 5,000 people to come up with their data, while the household survey, which is released as part of the employment report, which we obviously get on Friday, that surveys around 60,000 people. Now, of course, the smaller the sample size, the more easily that survey can be skewed by outlier results. Speaking of skew, the data, and this is the second bone that I have to pick with the people who put this together, the data is horrifically skewed by political party allegiance. If you dig into the numbers, Republican voters, their 5 to 10-year inflation expectations, that stands at 1.3%, which is obviously sort of some kind of economic nirvana akin to what we saw in 2017, 2018, when everyone was worried about how we get inflation back to 2%. Meanwhile, if you look at Democrat inflation expectations, they stand at 4.6%. So if you're a Democrat, you clearly think that the US is going to endure some sort of Zimbabwe-esque hyperinflation scenario. The nub of all of this is that there is absolutely no signal in the data whatsoever. And anyone who is pointing to this going, oh, that means there's going to be stagflation in the United States, ignore them. It's absolute fucking nonsense, to be completely honest with you. Yes, if there is hard data that proves that inflation expectations are rising, or if a wider survey proves that, then yeah, I'm going to buy into your idea. But if you're basing it on what 500 random people said on the phone, based purely on who they voted for 6 months ago, I'm sorry, I'm going to ignore every single word that you say.
Listeners, I
Lastly,
don't know about you, but when Michael gets all ranty and sweary, I get quite aroused.
well, I've just had a message from our good friend Paul telling me to breathe slowly in through the mouth and out through the nose. So I'll do that in a moment. But firstly, I do need to mention something that we've been discussing at quite some length recently is this deal in Panama. Of course, C.K. Hutchinson had been
Yeah.
seeking to sell some ports in Panama and around the canal to, I believe was it BlackRock they were selling them to?
Yes,
Someone
it
like
was.
that. Well, anyway, they are now not going to sign that deal. That was due to be signed this week. They have been coming under some very, very severe pressure from the Chinese government not to sign that deal. And
Well, to be
it
fair,
looks like, well,
and the
hang on. It looks like the
oh,
deal
sorry.
has finally been sunk.
Oh God, see, that's why I wanted to. That's why I wanted to like butt in. But to be fair, I got to say it's one of the only things that I can remember in recent history where the US and China have been banging the same drum, because both of them said that both those ports were of like strategic national interest. Um, so yeah, no, I think the nail was in the coffin on that one probably last week. So I know Angie on the Grain Market Blast has raised it a few times for exactly that reason. Both the US and China were getting very anti it. But yeah, one to keep an eye on, because like with all these things, when we hear that it's over, but because they've been so close to selling it once, chances are they'll come up with some other way of offloading it. I did see this
Yes.
morning that they've sold another area of their company this morning, or they're in the process of it. So it sounds like doing a bit of a HSBC and just trying to sell.
Well, I can't blame them, to be honest. I mean, they've lost their biggest customer, because I left Hutchinson 3, the mobile network here in the UK, last month. So, you know,
We all know
times
how
must be
much
tough
you
for them.
love. No, actually, no, I'm going to stop there because I was going to do a very weird tangent, so I'll stop directly there. Cool. Is that you done?
That is me
Well, for
done for the
now.
moment, yes.
Perfect. Well, thank you for that. Thank you for finishing on a rant. I very much appreciated it. I'm sure our listeners did too. Now, just for some overnight news, courtesy of Zach, who is on the slopes and still providing the overnight news roundup. I'm actually going to do it in a slightly different way today, so I'm keen for some feedback after I've done it, assuming that I don't mess it completely up. But anyway, some the gist of the overnight news roundup. Again, if you want the full gist, or sorry, if you want the full overnight news roundup, go to Zach's Twitter, our Twitter, or our Substack, or indeed our content hub on the website. But now to crack on, obviously we've got breaking developments on President Trump's plans to unleash broader tariffs, China's upbeat manufacturing data, and potential global shift in semiconductor spending. So starting with universal tariff and trade. Over the weekend, major outlets reported that President Trump is pushing his advisors to go bigger on tariffs on April the 2nd, possibly a universal tariff on most imports with no immediate carve outs. That's going to make horrendous reading for anyone at the big banks that have been putting together these really fancy tariff kind of timeline spreadsheets and that. Why you'd ever commit to doing that, I don't know, because it's been changing daily, but there you go. Although the White House insiders have been urging caution, Trump has hinted he's ready to let the economy quote, take a hit, unquote, if it forces other countries to the table. A universal approach could drastically reshape global supply chains. Meanwhile, the White House also says any specific country deals to avoid tariffs would come after the initial announcement on April the 2nd. So that ties in what myself, Michael, and Helen has been saying, that April the 2nd is just the beginning.
Mm.
In terms of market sentiment,
I think also,
um,
sorry,
yeah, go on.
am I allowed to interrupt your new format?
Of course, mate. Of course. Gives me time to read ahead.
Yeah, very true. Yes, I was going to say, I think that's an important one, because one thing that I know the UK government were trying was to basically head off reciprocal tariffs and never get them imposed in the first place. And I think the dynamic has clearly now shifted to everyone's going to get a number, and then it's a case of either reducing that number as much as you can, or getting rid of the reciprocal tariff as quickly as you can. And of course, what I would say on that is once the tariff has been imposed, it's a lot more difficult, sorry, to get it completely removed again, compared to just stopping it going into place in the first place.
Oh, there you go. There you go. I'll take your word for it. I'm no tariff law expert, but yeah, sounds feasible. Um, Market sentiment. News has triggered. Obviously, the news we've had over the weekend has triggered a risk-off move this morning. Goldman Sachs have also raised the odds of a U.S. recession to 35%, while trimming growth
Oh,
estimates and cutting its S&P 500 forecast. Go on, sorry.
where's Dario?
Oh, good point. Actually, good
You know
point.
his
Also,
favourite number is 40%.
there you go. One thing I will say about the dreaded R word, real, like when I say real traders, I mean trading professionals. It's not like they change their style of trading or anything as soon as it's officially confirmed as a recession. People that hang on like the official determination to be classified as a recession, you're by nature, by default, by the way it's worked out, you're already behind the curve.
Hmm.
So I don't really get this whole, you know, mad cult of will there, won't there be a recession. The fact is, we can skirt a recession and the economy and stocks can still be in the shithouse. But there you go. Just me, maybe. Auto stocks could be hit especially hard. Morgan Stanley says dealers have 2 to 3 months of inventory, but come May, vehicle prices could spike 11 to 12% due to tariffs. An interesting one on this one. If anyone remembers during COVID, it feels like a lifetime ago now. But it was second-hand cars was trading at sometimes to a premium to new cars, of like for like. So be interesting one to see how that takes off, because also secondhand cars also had a massive impact on the inflation data. So just kind of, I'm not saying we repeat ourselves, but obviously history rhymes, etc. So one to bear in mind. Some Republicans worry it's complicating efforts to extend Trump's 2017 tax cuts. Fed officials Collins and Barkin both noted inflation could rise, though Barkin suggests the cost might not fully pass through to consumers. What's next for the US? So on the White House timeline, obviously we've got April the 2nd as the key date. We expect new reciprocal tariffs, but obviously leading up to this, as we've all already alluded to today, expect plenty of headlines before and even more after. Trump has been quoted as saying, I couldn't care less if automakers raise prices. Consumers will just buy American, unquote.
Jesus.
Yeah, we'll see how that one plays out. Aides are confirming he is truly indifferent about short-term economic pain, convinced other nations will cave. Peter Navarro, a top trade advisor, says these tariffs will rake in $600 billion with a B per year, but critics dispute that figure. Politically, some inside the GOP are anxious about second quarter growth sliding. Well, with Trump's language like that, I reckon it probably will slide if he's got no interest. International reaction outside the US. Here's how others are responding. Germany Chancellor Scholz pledged the EU will retaliate as one of, if sorry, it as one. Sorry, I'll start again. Scholz pledged the EU will retaliate as one. There you go. If Washington slaps steel, aluminium tariffs and duties on Europe, France, Ireland, and farm unions want to scale back in agricultural items on the EU's retaliation list. In the UK, PM Starmer concedes a full trade deal by April 2nd is unlikely, but negotiations with Trump continue. He says he won't retaliate, focusing on economic prosperity talks. Meanwhile, in Asia, China's PMIs came in strong for March, suggesting factories are speeding up before US tariffs bite. Beijing, as we said before, we have commented on this a few times. We see a lot of front loading in data, which normally means we're going to see some bad data following this, where it's kind of
Hmm.
get all pushed ahead of the tariff news. So again, just having to have on your radar. Beijing is letting four state banks raise $72 billion to reinforce capital amid property woes and upcoming trade storms. Japan's factory output beat forecast, but retail demand looks shaky. The Nikkei is suffering its worst quarter since March 2020 on global trade concerns.
And it's now
Uh,
in a correction as well. We're down over
there
10%
you
from
go.
the high last year.
There you go, added colour from Mr. Brown. Some corporate spotlight now. Few corporate specific highlights. Automakers, car shoppers are rushing to buy before the 25% tariff vehicle hike on April 3rd comes into play. Nvidia, that's obviously in the US. Nvidia big tech, rumours are swirling about a reduced AI spending from major cloud providers, possibly favouring cheaper or older chips. Two things on this. Zach's actually put out one of his tweets today that I reposted about the spending and that coming down on the cloud providers and kind of just the infrastructure and stuff. And I do remember it might have even been Michael that you tagged our dear friend Tom about how Nvidia are speeding up the release cycle of chips, which obviously means that the buyers of these chips basically have to be forced to keep buying every year or so rather than every say 2 to 3 years, which could anger some of the bigger buyers such as like Meta, Alphabet, etc. like that. So one to keep an eye on. And finally, Aston Martin warns US tariffs will hit volumes, raising fresh capital from investor Lawrence Stroll. And that's a roundup for today from me. Obviously, we're going to keep an eye on White House tariff announcements, especially towards the April 2nd. And as always, keep tuned in and keep logged into your PIQ Suite platform, where obviously we've got all the breaking news via Reuters, Bloomberg, also Twitter feeds are on there, and also your business TV channels. So keep an eye on that. But that's it from me. Back to Michael Brown in the studio.
Indeed, yes. Thank you, Ryan. As long as Aston Martin don't want any more money from their sponsors, they should be all right on that front.
So you haven't mentioned Pepperstone have sponsored Aston Martin. There you go. Shameless plug.
Anyway, moving on from that, in terms of the week ahead, of course, there is going to be plenty of focus on trade, which I'll get to momentarily. But just to cover off today, first of all, at 9 o'clock, so in about 5 minutes' time, we get all of the regional inflation prints out of Germany. And then at 1 o'clock this afternoon, we get the overall inflation figure. CPI is seen at 2.2% on an annual basis in March, down from the 2.3% that we saw in February, forgive me. We also have out of the States today the latest Chicago PMI figures. That index expected at 45, down from a prior 45.5. The figure, of course, publicly released at 2:45 London time, although the data is out 3 minutes early to those lucky folk who subscribe to MNI. In terms of other things just to keep an eye on today, two kind of housekeeping issues. Firstly, of course, UK clocks went forward over the weekend, so the London-New York time difference is back at its usual 5 hours. Don't let that catch you out. And secondly, it is, of course, the last day of the month and the last day of the quarter as well. So potential for rebalancing flows in the mix, although you would expect at this point that most of that has probably been done. In terms of the remainder of the week, then, just to cover off trade, first of all, of course, all eyes are on Liberation Day on Wednesday, when we're supposedly going to get these reciprocal tariff announcements. Of course, journalists will not only be trying to scoop that announcement and get a bit of a leak on what that could be, but also at any possible opportunity will be asking Trump what he is likely to do. I believe there are a couple of scheduled media appearances from Trump today where he's due to be signing executive orders, so do just bear that in mind. The second thing to bear in mind, and this probably hasn't attracted the attention it deserves, is that on Tuesday, so tomorrow, various federal agencies, so Treasury, Commerce, etc., are going to be delivering reports to the president on all of the trade studies that they have been doing since Inauguration Day. I'm sure you'll recall that on Inauguration Day itself, I think it was Washington Post reported that tariffs won't come in until April and there's going to be a study first, which gave risk a big boost. Well, those studies report back tomorrow. God only knows what they're going to say. Also, God knows whether Trump's actually going to use that information when coming up with the reciprocal levies. But nonetheless, I think it's something important just to bear in mind. In terms of scheduled catalysts, though, for the week ahead, just to go through day by day very quickly, tomorrow we have a policy decision due from the Reserve Bank of Australia. They're expected to hold rates steady at 4.1%. We also have manufacturing PMI figures from pretty much every major economy, including the ISM figure out of the States, with that index expected at 49.5, dipping back into contractionary territory from a prior 50.3. And we also have the latest inflation figures out of the Eurozone tomorrow, with headline CPI seen rising 2.2%, down from a prior 2.3. Moving on to Wednesday, of course, it is Liberation Day in the United States. Not a bank holiday, despite what some people have been asking me. But we also get the ADP employment figures. Yes. We also get the ADP employment data and February's factory orders print out of the States on Wednesday as well. Moving into Thursday, it is, of course, Services PMI Day, including the ISM Services print out of the States. That index expected at 53, down from a prior 53.5. We also have CPI data from Switzerland, the weekly jobless claims data out of the States, and minutes from the March ECB meeting. And then last but by no means least, into Friday, it is, of course, Jobs Day with the latest US labour market report due. Headline non-farm payrolls seen rising by 140,000 in March, while unemployment is expected to hold steady at 4.1%. Also on Friday, we have jobs data out of Canada, a speech from Fed Chair Jay Powell, and by far the most important event, drinks after work with Ryan and I. And that is your lot for this morning.
Exactly that. And just to reiterate, Michael Brown may be putting his card behind the bar. Sources, no. Rumours, sources.
Get better sources.
Yeah, true that. Michael, thank you so much for doing what you do best today, which is ranting and providing us with some much needed added value to our day. Listeners, thank you so much for tuning in. I hope we have, speaking of value, I hope we've added some value to your day, maybe even put a smile on your face. And we will see you all tomorrow and hopefully on Friday if you are London based or UK based. But yeah, take care. Have a good one.
Indeed. Bye for now.